Are you looking to expand your real estate investing portfolio with commercial properties? And if so, are you looking for bank financing? Well, if that's the case, then you need to understand the concept of debt coverage ratio. We're going to go over that in this video right here. Today the topic is debt coverage ratio. You're going to find debt coverage ratio as a tool that banks use, that lenders use, to see if they're going to fund your project, which most commonly is a commercial real estate investment. Sometimes banks use it for corporate reasons, but in our case, it's specific for real estate investing. So debt coverage ratio, also known as DCR, debt coverage ratio, can also be termed debt service coverage ratio, DSCR. That's the same thing. And what debt coverage ratio is it is a measure to determine that the real estate investment that you're looking to buy, that it will make enough cash flow, enough money as a rental in order to cover the debt service per month or per year. So the formula that's used for debt coverage ratio, DCR, is the net operating income, the annual net operating income of the property divided by the debt service. Debt service. So you can see, based on this formula, you want the net operating income of the property, which we're going to go over in just a second. You're going to want that amount to be higher than the debt service. Therefore, the property itself covers the cost of the loan. So we'll go right into a little more detail into this and into an example for it. Okay, so here's an example. Let's say you want to buy a 6-unit property, a commercial real estate property that you want to rent out. So you have a building with 6 doors here, and let's say for each one, when it comes to the revenue, each unit is going to have a rent of $500 per month. Okay, so if you multiply that by 6, that comes out to a revenue of $3,000 per month. Okay, now we'll keep it simple in this example. Let's just say that nobody is leaving, no one's vacating, and so let's assume in this example that you don't have to worry about vacancy. Usually you do have to worry about it in real life, like if the vacancy rate of the area that you're buying in is, say, 5%, then you have to account for that in this number. Let's just take this example without that. Okay, so the revenue of $3,000 per month, and then from there you look at the expenses, and of course the expenses include the utilities, they include the property tax, property management, they include the insurance on the units on the property, and capital expenditures, and a host of other things that we have to take into account when we're calculating out our cash flow. So let's say for this 6-unit property, per month, the expenses total comes out to, let's just say it's about 30% of the revenue. Let's say the total comes out to $1,000 a month. Again, of course, a very simplified example. So in this case, the net operating income monthly is your revenue minus your expenses. So in this case, it is $2,000 per month. So in this example, we're gonna stick to months here. So with a net operating income of $2,000, from there you have to determine what it is that your debt coverage ratio is going to be based on this average monthly set of numbers. So let's say that you are looking to purchase the property and you get it for a sale price of $400,000. Okay. From there, I calculated out that approximately for a $400,000 purchase and a down payment of 25%, which is pretty common for commercial properties, and I just used an average interest rate of 5%, the monthly debt service comes out to approximately $1,600. Okay, so now I'm going to go over here and put down our debt coverage ratio. Monthly, in this case, is your net operating income per month of $2,000 divided by your monthly debt service, which is $1,600. And when you calculate that out, that comes out to 1.25. All right, so a general debt coverage ratio banks like to see is at least 1.2. Now, that is very general, and it really depends on the bank you're working with. If the property is a solid property in a great location and your bank knows that it will cash flow, then they may accept a debt coverage ratio that's a little bit lower than that, lower than 1.2. Sometimes if they're more conservative, they may want 1.3. So this brings about two important points. Number one, that remember, real estate is local, and it's always very good to get to know local bankers, and because they may fund something that a national bank may not fund you, only because they know the property, they know the area much better. So they may fund you for something that might be considered a little bit more risky on paper, but they know it's a sure deal. So one thing is that it is very much a local business, real estate investing, and also the second thing is they also not only look at the property, to some extent they look at you as the investor, and that also determines how conservative or liberal they're going to be with a debt coverage ratio. But just keep in mind that 1.2 is kind of a rule of thumb. So this was a simple overview of debt coverage ratio, what it is and how to calculate it. And so when you go to a bank and you're interested in a real estate investment opportunity, you want to have all of this calculated out to the best you can, and have an idea of what your debt coverage ratio is going to be. And if you can present that to the bank along with your numbers, then you will be that much ahead when it comes to the financing part of it, and that will only increase your chances of getting financing and getting the deal closed. So we hope you like this content, and if you do, give us a like, and definitely comment below on debt coverage ratio and your experience with debt coverage ratio and any issues you've encountered while you've been investing in real estate. And go ahead and subscribe to our channel so that you can get more content like this on a regular basis. So thanks for joining us, and we'll see you on the next video.